Good morning from our global headquarters in New York. I'm Manus Cranny alongside Danny Berger. It is Bloomberg Brief. Let's set your agenda.
Futures rally as Powell keeps the dream of cuts alive, but is less certain on timing and pushes back against hikes. Another volatile session for the yen, adding fuel to the speculation of intervention. And Apple results later today may show how the iPhone maker is coping with a sales slump.
Well, the Bears definitely had a vice-like grip on this market as we went into the Fed and the FOMC. But a lovely phrase from Standard Chartered. What Powell managed to do was put a distance between him and the hikes. He really did not inflame that narrative. Rate cuts, they are perhaps delayed, but they are not derailed. That is the narrative. Now, the equity market in of itself had a tough time because AMD came out with a chip forecast that disappointed. Down went the stock by nearly 9%, and she is bid up this morning. Have a look at the bottom of your screen. You can see a slightly better bid on AMD. So that's turning that around. Here we are. We're down by 5-6 basis points on the bond market yesterday at one juncture. As I say, this is a Fed and a Fed put that squarely lives there. We're down by another bip at the moment. Dollar yen, I'm just looking at the bottom of the screen. You are looking at a red headline right now on Bloomberg. The Bank of Japan accounts point to an intervention of about 3.5 trillion yen. Keep an eye on dollar yen because, of course, we had this speculation. It rallied by 3%, gave 50% of that rally back. Is the Bank of Japan winning or losing the unilateral battle of intervention? Danny, the details.
So, Manus, just looking at the numbers, so 3.5 trillion yen, as you mentioned, intervention yesterday. I'm just doing some quick math on my terminal here. That is about $20 billion. Let's put this into perspective. When they intervened last time, 35 billion. So this is slightly less than the last one. But remember, in 2022, they intervened with $62 billion. In this week alone, Manus, we are above $50 billion. We're about $55 billion, almost the totality of what they did in 2022.
And still, this market pushes back. So we had this suggestion that there was the intervention. It rallied by 3%. We looked at the chart this morning. It gave back 50% of that. The issue is this. Are they pushing? Are they throwing good money after bad when the Fed is higher for longer? It's not hiking, yes, is the narrative that we take away from the Fed yesterday. But they are higher for longer, and is this good money after bad? And I've said it, and I will say it again. On unilateral intervention, it is a folly.
Well, part of the problem is there was no real reason for the yen to weaken yesterday, primarily because you had a Fed that wasn't as hawkish as most people had feared. The fact that the yen did weaken shows that there's almost this sense of bond vigilantes, but in yen land, that are willing to test the MOF. They tested them. They got intervention of, again, 3.5 trillion worth of yen, which is about $20 billion. But how much of an effect did it really have? Let's bring in our FX strategist. That is Vasilis Karaminis. Vasilis, we have the numbers now with us that it looks like they intervened with about 3.5 trillion yen. Are they throwing good money after bad?
This is too good of a carry trade to give up on. That's the trader's perspective. As you said before, the fact that they spent almost already the whole amount they used back in 2022 shows that this is a market that really wants to buy this dip. And it will keep doing so as long as the Fed BOJ divergence stays intact. Now, it's one thing talking about, the Fed hiking or cutting rates. The real issue here is that the Bank of Japan is very, very slow in its tightening progress. Unless it goes on an aggressive hiking cycle, we would expect dollar again to be bought on every single dip. And they're probably going to be using loads and loads of money and during illiquid hours, which is kind of a key issue here, because Monday, Japan was out on a holiday. They came in yesterday after the Fed when liquidity was again low. There's talk among traders that they're going to do it again Friday or Monday when we have the Golden Week holidays in Japan. And mind you, UK is closed Monday as well. The fact that they are coming during such liquid hours, to me, shows that they're not confident they can go against this market. It's very, very determined to buy the dip in dollar yen.
Well, here's the issue, isn't it? It provokes the narrative then, what more must the Bank of Japan do? But Vasilis, if I look back at Friday from the Bank of Japan, they're lowering their inflation guidance for this year and for next year. And the narrative is that they don't want to hike rates and be that aggressive, but they may well be left with no alternative unless there is tripartite intervention as intimated by the letter delivered by the Japanese, by the South Koreans and by the Americans?
The Fed is the key here, yes. I mean, if you're a trader and you listen that the Fed's in the market selling dollar yen, you don't want to catch that falling knife. You'll just stay away from it. And that can be a big game changer. You can drop below 150 in a blink of an eye. I think, yes, unilateral intervention is what traders are not afraid of. If it gets more coordinated, then that's another story.
Vasilis, it's a scary prospect that the yen is perhaps tied to the fate of the Fed at this very moment because of what we heard yesterday. We heard a Fed that frankly has no idea when they're going to cut. They say they're not going to hike, but the direction and duration of how long we last where we are is so uncertain that we are so data dependent. Is that not this kind of action every single time we get a piece of U.S. data in that tells us something about what the Fed is going to do? Is that the kind of world we're living in with the yen?
Yes, it's true. It's true. We're very, very much data dependent across the FX space because, remember, it's very much dollar and Fed driven. Now we get the U.S. payrolls report tomorrow, and I believe that the Fed's focus has turned to the labor market more than the inflation front because, yes, the progress is not going as they hoped on the inflation path, but there is some progress. As long as the labor market stays robust, I don't think how the Fed can communicate a dovish turn. So yes, I think we're down to waiting every headline there, trying to find the next catalyst. Because if you look at the dollar traded weighted index as well, it's kind of like consolidating within a kind of a narrow range in the past 2-3 weeks. Because the market is waiting for that. We're waiting for data to signal if they're going to have to hit the bid or the offer in the dollar.
Okay, Vasilis, we'll keep an eye on dollar yen and all those time. The bar is high to begin those cuts in the United States of America unless there's something really radical happening in the employment market. And that's more or less what Powell said. But the put lives. Long live the Powell put. Vasilis Karamanlis on the breaking news from the Bank of Japan intervening. Other stories trending on your Bloomberg terminal this morning. This is what we got for you. The US and Saudi Arabia are nearing a historic pact offering the kingdom security guarantees and a path to diplomatic ties with Israel. Sources say officials are optimistic a deal can be reached within weeks. Israel is expected to be offered a choice to join the deal, dependent on ending the Gaza war and agreeing to path towards Palestinian statehood.
And New York police have arrested almost 300 people breaking up escalating protests over the Israel-Hamas war at 2 universities. The arrests were made at Columbia University and City College of New York. Police officials say outside agitators joined the Columbia protest, but are still determining how many non-students were arrested.
The Fed and other top U.S. regulators are forging ahead with a landmark plan to make big banks hold more capital, despite the calls for some critics to scrap it. Some officials are pushing for finalization as soon as August. Separately, JP Morgan expects to pay $100 million to settle a watchdog inquiry on trade monitoring gaps. Coming up in the show, we're going to discuss the Fed, the post-Fed analysis with Adam Posen, the president of the Peterson Institute for International Economics and a former Bank of England policy official.
But first, up next, Novo Nordisk declines despite an earnings beat and an outlook boost. Why? We're going to ask that question to Emily Fields of Barclays next. Context matters on Bloomberg.
As to Wegovy and the Wegovy launch and how that progresses, then the short story is that it's all on track compared to our plans. We have been raising our starter doses in the US from around 5,000 when we entered this year to more than 25,000 as of the latest weekly data point. So more than 5 times up compared to the start of the year.
Well, shares of Novo Nordisk are raising their post-earnings bump as the weight loss drug Wegovy double-digit sales overshadow the pharma giant's upgrade in its profit outlook. Emily Field is the head of European pharmaceutical research at Barclays. She has an overweight rating on Novo Nordisk. So, look, the stock has done phenomenally well. We are in the vortex of a global craze. I mean, that's, I think, a very sort of fair estimation, Emily. When you look at Novo Nordisk, when you look at Lilly, the issue is supply. keeping up with supply. They're going to spend $11 billion. Do you expect them to spend a lot more? Is that CapEx a good number? How do I estimate $11 billion in the supply narrative of Novo? Good morning.
Good morning. Thanks for having me. Yeah, so that is the $10,000 question, is how can we translate all of these investments in CapEx into number of doses that they're going to be able to produce? They've guided for a low double-digit percentage of sales going into CapEx for the foreseeable future, 45 billion kroner this year. They're doing the Catalent deal as well. So they are making all the investments they need. Unfortunately, it's just really hard for us to translate on our side. What does that mean in terms of doses this year, next year, et cetera? But everything's on track.
And Emily, I can't help but wonder how much of this is about pricing power, because there was a moment where, okay, if you want to get your hands on these, you'll spend whatever is within your means to get them. Yale University put out that study that caused the stir, saying they could produce this stuff for $5 when they're charging something closer to $1,000. As the consumer gets more price sensitive, does that hurt Novo? Does that hurt Lilly? Does that hurt all of these drugs that are pricey?
Yeah, great question. So we are modeling, a mid-single-digit price decline per annum on a net basis for Wegovy in our modeling. However, what Novo is going for is they want most people to get this through their insurance, whether that's commercial insurance. They're also starting to make inroads into Medicare. So the out-of-pocket cost for the consumer will be very little. The high price that they charge, optically, really is sort of a way for them to pay for the R&D that they're spending. And also, the thing is that these drugs are going to be cost deflators throughout the system. We just saw the cardiovascular benefit added to the label. That's going to keep people out of the hospital, which saves the system money.
When we look at their market share, it is approximately 55% of GLP-1s. When we talk about Elon Musk and his genius level, we talk about, I have had every fund manager in the world come in and tell me about the moat around Elon Musk and how it's impenetrable, etc. And that has obviously been penetrated quite aggressively so far in 2024. How strong is the moat around Novo? Just how much of a grip is that 55% of the market share, or how susceptible is that to real penetration?
So we think that the moat around Novo is twofold, and this includes Lilly. We think both of them are going to remain market leaders here for a multi-year period. One, it comes down to these supply investments. They're already so far ahead of all these companies that have entered the space. We'll see data from Amgen, Astra, Roche, et cetera. And then secondarily, there's an innovation gap. Novo presented data earlier this year at their Capital Markets Day for a phase 1 drug that had the best weight loss we've ever seen. So it feels like on both those fronts, everyone trying to enter this space is going to have to do their best to catch up, and that's going to take a while.
At the same time, Manus and I had a conversation with the Novartis CEO last quarter, Emily, and they, of course, don't have one of these weight loss drugs. So naturally, as you have to ask any pharmaceutical CEO these days, is to say, are you planning on developing one? Do you feel like you missed out? His answer was really interesting, Emily. He said, if you look at the current class of drugs, you have issues that I know some people are trying to address, like Lilly, but things like muscle loss, concerns about cardiovascular issues. And he said, if he develops something like that, he wants to address those specifically. Is there not a potential for someone to come and disrupt the market and put out something better that perhaps is less risky for those specific issues?
That's exactly right. I think because Novo and Lilly have such an advantage just on the efficacy on weight loss, for example, companies like Astra that are trying to enter the space are exactly using that angle of we're coming in on the cardiovascular side. However, cardiovascular trials take a very, very long time to run. Novo's SELECT study took 5 years. So again, it still will take some time for anyone else to be able to produce the data so that they can present that to regulators.
Okay, Emily, thank you so much for that. Barclays' Emily Field, appreciate you coming in this morning. And the Bloomberg team will be speaking to the CEO of Novo Nordisk. Don't miss that, 10:30 a.m. Eastern. Okay, let's get to some other big European earnings. We got Shell out. It's getting a boost. It had a strong first quarter, and it also kept up the pace of buybacks. Let's get over to Bloomberg's Will Kennedy, who joins us now from London. So the buyback giant continues to buy back. Another strong set of earnings. Will, what was your takeaway?
It was a very good quarter, Danny. As you say, an earnings beat, strong cash flow, debt is falling, they've got capital spending under control, the giant trading business continues to perform well. So all in all, it was a very good start to the year for Shell, and emphasises that the CEO, Wael Sawan, is so far being able to do what he set out, which is basically to concentrate on oil and gas and maximize returns for shareholders.
And just looking at the capex, Will, and this is obviously capex very much under control, $4.49 billion expenditure in the first quarter. That's about $2 billion less than a year earlier and down. So the market's going to like this kind of control narrative around capex because it's been the thorn in the commodity and in the oil producers' side. What's your take on that?
Yes, absolutely. People do like to see that. It obviously provides more money for debt reduction and distributions to shareholders, which has really been the mantra of the oil and gas industry the last few years. And it's, I think, important that companies like Shell have got through this inflationary episode without a huge uplift in their cost base, and that they are managing to do what they need to do relatively cheaply. That said, I do think one thing for the industry is that as oil and gas demand continues to rise and perhaps outperform people's expectations, there may be some questions asked about where the next projects are coming from, where they can add a bit more oil and gas. So it is an important narrative. It is a strong narrative they want to be, but I think in future quarters perhaps we should look for it to shift just a tiny bit.
Look, just briefly before we let you go, Will, obviously we've seen quite a significant M&A activity here in the US side of the oil and gas business, perhaps less so from the Europeans. Is that another story, another narrative that may build?
Well, a lot of the activity has been focused on two things in the US, the Permian Basin in Texas, where we've seen a lot of consolidation, driven in part, you're right, by Exxon and Chevron, but it's really about bringing producers together to drive down costs. And then obviously we've got Chevron's acquisition of Hess, which is all about increasing its position in Guyana, where Exxon already is this new exciting play in South America. Now, the Europeans aren't able to play in Guyana. It seems that the US companies have a lock on that, and they're not going to be the same presence in the Permian. So they're outside of those two trends. I think while Sarwan at Shell has said that his current plans don't include any big deals. I mean, you never say never. Obviously, 10 years ago, Shell bought BG. But I don't think it's something that people are very focused on in the European sector right now.
OK, Will, thank you very much. It's worth throwing that sprig out there. Will Kennedy on the Shell results. Now, one sprig that was to catch a whale was intervention by the Bank of Japan. So it was mooted this morning, Danny, and we now have confirmation that they spent another $28 billion. So what does that take us for the week? That takes us to almost $60 billion in intervention. I'm rounding. It's the death of Danny and I. It'll be the rounding. $28.1 billion today, plus $34 billion. So that's $62 billion. We're pretty much at the money.
And again, this is the problem. If they have to spend the entirety of what they spent in 2022 in just 1 week of intervening, what does that say about the success of this intervention? And we're likely to get more yen volatility. This isn't the last time we're going to see the yen likely pop to something like 158 versus the dollar. Every piece of hot data that's going to come in, because the Fed is so data dependent, will move the yen. How much money are they going to spend on this? Is it sustainable?
Yeah, and just a quick correction from me. That's the current account will probably fall to $28 billion.
It's something more like $22 billion they spent, man.
It's $22 billion. That's a quick correction on that. But it's about, they're fighting a losing battle against a higher for longer US and indeed unilateralism. We'll have more on the story in just a moment.
It's Bloomberg Brief, Danny Berger and Manus Cranny in New York. Shall we get to some of the front pages?
A little bit of a soupçon of what's going on around the world. First up, you've got the Wall Street Journal. They're talking about Exxon setting to close to $60 billion mega deal for Pioneer Natural Resources. And that follows the agreement with the FTC not to add the former Pioneer CEO, Scott Sheffield, to the board of directors. Now, the FTC, that was set to allege Sheffield engaged in collusive activity that has raised the price of oil.
Yeah, and we know the FTC has been cracking down quite a bit on mergers.
Indeed.
Okay,
Understatement.
yes. So next up in the New York Times, Manus, we have this about Arizona. Lawmakers there voted Wednesday to repeal an abortion ban that first became law pre-Roe in 1864. 2 Republican senators broke with their party to ensure the final passage, and Democratic Governor Katie Hobbs is expected to sign it on Thursday.
Now, if you're one of 3,000 young people out there who applied for an internship at Tesla, it's not looking good. The EV maker has been laying off staff in cost-cutting efforts, and Elon Musk said last month that Tesla made a decision to reduce the headcount by 10%. We understand that if you're an intern or a community college applicant, it's not going to happen for you at your internship at Tesla.
I want to read what one Miami University student said because it's really sad. At 8:46 a.m., I opened a Tesla email for flight info. By 11:25 a.m., my internship offer was gone, and noted that he already spent thousands on housing. That's tough.
It is the brutal reality. So, I mean, that stock rallied up by 15% on money. It's incrementally given it back.
Yeah.
I mean, the rally of 15% was all around autonomous driving story in China, wasn't it?
Yes, it was. It shows the chaos within Tesla, the chaos of trying to trade this thing, and now potentially a talent pipeline.
Adam Posen joins us next from the Peterson Institute.
From our global headquarters in New York, I'm Danny Berger alongside Manish Krani. Let's set your agenda.
U.S. futures rise as the Fed Chair Jay Powell keeps the rate cut dream alive and pushes back against rate hikes. Another volatile session for the yen. According to Bloomberg analysis, the central bank accounts Japan likely conducted its second currency intervention this week. And the Apple results due later today may show the iPhone maker is coping with a sales slump. Danny, good morning.
Good morning. Can Apple earnings juice this equity market? I gotta say, strange reaction to the Fed yesterday. Initially a rally because Powell batted down any suggestion of a hike, eventually turned into losses, and yet again we are higher this morning, up about 0.5%. Two-year yield will back under 5%. A more sanguine reaction to bonds because, let's be honest, did Powell say anything new? Not really. Fed fund futures didn't change their pricing at all. So there we go, back below 5%. Dollar yen, that's where the drama is. We go from 158 to 153 in the blink of an eye. Early afternoon yesterday, around 4 p.m. We're at 155 this morning. The current account suggests that, yes, Manis, the BOJ did intervene 3.5 trillion yen, which is about $22.5 billion. So the total now 57 billion, something close to the entirety of what they spent in 2022.
Yeah, well, the debate now is that good money after bad in the face of a higher for longer Federal Reserve and acting unilaterally. Now, we spent much of the morning talking about the Federal Reserve, and the Fed Chair Jay Powell kept hopes alive for a cut this year while acknowledging that a burst of inflation has reduced the odds of it coming soon.
In recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. It is likely that gaining such greater confidence will take longer than previously expected. I think it's unlikely that the next policy rate move will be a hike. I do think it's clear that that policy is restrictive, and we believe over time it will be sufficiently restrictive. I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope. See if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. We just don't go down that road. If you go down that road, where do you stop?
Well, that is the Fed Chair Jay Powell. Joining us now is Adam Posen, president of the Peterson Institute for International Economics and former Bank of England official. Adam, good to see you. You've had time to chew it over. I like what Standard Chartered said about this. They said, look, he's reduced the tail risk of a hike, and he has distanced himself from that. Was that perhaps the prime objective whilst keeping the dream of rate cuts alive?
I think the distancing term is right, but I'm not sure he can distance himself from the reality. So the reality is that inflation's been moving sideways. The reality is the U.S. economy is still growing very strongly. And the reality is you've still got a lot of fiscal stimulus in the system. So he can distance himself all he wants, but in the end, I don't think the cuts priced in for 2025 are going to happen.
Well, to that point, I just want to go back to what Powell said. He said if we had a path where inflation proves more persistent, where the labor market is strong, and we're not getting greater confidence, that would be the case to hold off cuts. You could literally have taken all of that and followed with that would be the case
for the hike.
To hike.
You're absolutely right. You're absolutely right. I
So what do you make of
completely
that?
agree with you, Danny. Again, I think he's trying to say things that are not going to be supported. If you get to that point, it goes to something else he said, which is he's claiming the committee believes that policy is sufficiently restrictive. It's only a matter of time. And I think that's a mistake. I think that, 6 months, 8 months ago, New York Fed, Williams, Dallas Fed, Logan were both saying, oh, well, as inflation comes down, the real rate's going to tighten and we're going to maybe have a recession. That hasn't happened. Credit conditions are still quite loose. Spreads, which are what I look at as most important, they're quite narrow. So you've got a few interest rate sensitive sectors that are just starting to show a little bit of something. And what that tells me is they haven't tightened enough.
Well, if they haven't tightened enough, then would you be an advocate? I mean, you've worked on these panels. Would you be sitting around that table and advocating, to be more open-minded to a hike?
Yeah, at a minimum, I would not have made the communications that the chair made yesterday. I mean, the chair obviously is reading the committee, and as you said, though, I mean, I would not have made the statement that said, if the following inflationary things happen, then we're on hold. I would have said it's an evenly balanced situation, or as my colleagues have said, there may be reason for a hike. And calming down markets is not supposed to be a goal here.
But to be fair, Adam, his colleague Williams, who talked about a hike, I mean, he basically said, yeah, if the data does it, then we'll do it.
Oh, yeah.
But that's like any good central banker would say something like that. But the fact we're not getting more forceful, maybe we need to hike. I think a journalist asked this to Powell, sort of a lack of disagreement at the Fed, a lack of diversity of thought. Is that a problem?
It's too soon to say that. Because we have seen, to their credit, in line with what you just said, that Williams and others have changed their tune. It's a little disturbing that everything's chasing the last data point. So instead of worrying about consensus on the committee, what you might want to say is, we're roughly in the right place. When you're in roughly the right place, it's hard to make the call. If we were totally behind the curve, like we were a year and a half ago, then it's obvious what direction you want to go. But since the economy's doing pretty well, we're not yet at target, it's actually a hard call. And so instead of saying there's consensus in the committee, say the committee is split or the committee is deliberating. Again, give a different tone. If you're going to be data dependent, don't be so definitive.
You would also say not just is this economy strong, but we're going to have almost like a second boom into this election. And that's partly based on the thesis of an acceleration in immigration.
Well, my colleague Karen Dinan at the Peterson Institute has spoken about this. Other analysts have as well. The fact is, the CBO's pointed this out. We've had roughly 6 million more people come in the last 3 or 4 years than in previous years. Excuse me, not in previous years, than was projected.
Yeah.
And when you're normally having a couple million come in, that's a very big overhead. And as an economist, as opposed to a border state politician, this is an unmistakably good thing. It increases labor supply, which increases the potential growth rate of the economy, it increases demand, it on net raises the better balance sheet for the federal government because immigrants tend to pay in much more than they take out. It improves their demographic profile. Boom, 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 boom. Immigration good as long as you're an economist. So this is also ultimately disinflationary because we wouldn't be at 3.5, 3.7, 3.8% unemployment with wages growing where they are without more inflation if we didn't have this additional supply of workers.
So what then, Adam, happens if we get a president after this year who cracks down hard on immigration and stymies the flow?
It's bad news. We at Peterson are doing some modeling of this, trying to put numbers on it, but it's akin to what the UK went through initially after Brexit, where suddenly they had shortages of workers from Europe, and we would see shortages almost immediately in residential construction. We're already not doing enough. In agriculture, in cleaning, in residential services, in hospitality, meaning restaurants, hotels, every short-term transport. And so then you get higher, not just higher wages in those sectors, but you have to try to bid people who normally don't want to do those jobs into those sectors. So I don't want to put a number yet. Have me back in 6 weeks. I'll give you an accurate, a best estimate. I'll give you my best estimate.
You mean you're committing to coming in again at 5:30 in 6 weeks?
I'm committing to get on Zoom at 5:30 in 6 weeks.
We'll take it.
But thank you for that. But just to say, I mean, the numbers. So I can give you a number, but I don't want to give you a number yet. But I mean, it would be, 1-2% jump in inflation. immediately. And then this isn't good wage growth, right? This is like what we saw coming out of COVID, where you have shortages, and that spills over into the rest of the economy.
Well, that could be quite immediate. That could be really quite immediate in the 2025 if we have a change in regime. Can we just close off on this? I've lived through a few cycles. Danny's lived through a few less, and you've lived through a few as well. The world survived at 5%. We grew when the world was at 5% interest rates. It's a long time ago. It's okay. I'm laughing. Here we are. This market is just so desperate to return to a pre-COVID.
No, but it's not. It's not, because when you look at anything other than the equity index, right, the economy's doing well.
No, I'm saying markets are desperate, but the reality is something different. There's going to be a higher neutral rate, and we need to understand that. Sorry. My apologies.
No, I interrupted. You're absolutely right, Manus. I'm getting everything wrong. There is this concept of R-star, which is the underlying interest rate the economy is at when you're at full employment and target inflation. It's an abstract concept, as Powell has rightly said. You can't measure it, you can't taste it. But anyway, there is a basic idea that you live in a low or a high interest rate world. And there's a lot of reasons to think that we were in a very low interest rate world from roughly 2004 till COVID. And then the question is, things shot up temporarily, but it doesn't stay up. And in my view, R-star stays up. We've got a lot of fiscal in the pipeline. We're going to spend more on defense. We're going to spend more on green, I hope. We're going to spend more on industrial policy, unfortunately. And these are chunky numbers. This is like, as Larry Summers has said, this is like running the Cold War drawdown in defense spending in reverse. We've got arguably an increase in productivity. It has to be an increase that's ongoing, increase in the trend rate of productivity. And we've got potentially, if Trump doesn't start deporting human beings in the millions, we've got a bigger population and a younger population versus what we had. So you put all that together, that should drive up the interest rate. That should drive up the cost, the return on capital on average in the society, and that's your R-star. You also put in a little bit for continued inflation risk. And so, the reality is an R-star, which brings us back to the Fed decision. The Powell Fed has said this. I mean, in the last dot plot, they raised their 10-year, their projection on the 10-year Treasury 25 bips, which isn't anything, but that's going to keep going up.
Okay, Adam, we're going to turn to the rest of the world shortly, so stay with us. Adam Posen of the Peterson Institute of International Economics. You're watching Bloomberg Brief. Danny Berger and Manus Cranny in New York. Now, we're tracking the yen this morning. We got the data from the BOJ, the current accounts. It points to yet another round of intervention, this time 3.5 trillion yen, which is about the equivalent of $22.5 billion. We're back with Adam Posen, president of the Peterson Institute for International Economics, who's also a former Bank of England policymaker. Adam, if you add these two figures up together, 35 on Monday, 22.5 billion, you get something close to what they spent for the entirety of 2022. And what we have to show for it is about 156 on the end, something that looked like what we saw last week. So perhaps little reward for a lot of money. Are they throwing good money after bad?
They're still only throwing little money. Try to have a bit of perspective on this, Danny. I know you're absolutely right. They didn't do much the year before or the year before that because they haven't been intervening. But if you go back several years, so like when the Chinese renminbi was crashing down in the second half of 2015, they ended up spending $1 trillion of reserves. So 50 times what the Japanese yen did. So it's not yet big money. Now, the more important point is there's a tension, and you and I and Manus were talking about this during the break. There's a tension between BOJ Governor Ueda coming out, as he did at the Peterson Institute a week ago Friday and the Diet last week, saying monetary policy is not driven by the exchange rate. The exchange rate's not a target of monetary policy. We're ready to raise rates, but we don't have to do it quickly. I'm paraphrasing.
Right.
Yeah. But and the intervention. And so either the BOJ's policy statement isn't as strong as it sounds, or the intervention isn't ultimately going to work because monetary policy isn't going to move. And I think it's more likely the latter. Monetary policy doesn't move, so intervention doesn't work.
I mean, one could say that the language used and then the action taken, he's been undermined. You say that $1 trillion is what was spent before. Do you think it takes more than unilateral action this time around? It's a different world. We are dealing with a different Fed at a different moment in time in a different regime. A different global regime. They're not getting their bang for the buck. We know that they've got to spend up to $1 trillion maybe to be equal to that. But do you need tripartite intervention? Do you need G2, G3 intervention to materially shift yen?
It's necessary but not sufficient. So I agree with you. We're in a world where secular trend, going back to what we said about Powell before the break, Fed is not going to cut, in my view, in 2025 and 2026 anywhere near what people think. And so what's already the secular dollar uptrend is just going to continue. And then if you get fiscal laxity from the new president, and depending on how the Congress looks, you get a further short-term boost. So, you know, you're looking at something more like the late 80s, as people have started to say, is this room for another Plaza Accord? And that gets us to the question of multilateral or group intervention. I think if you're going to do intervention, it's much more effective if you do it as a group. I think since Lael Brainerd, who's now, of course, at the White House, but was Treasury Undersecretary, negotiated this sort of G7 plus China deal that you don't unilaterally intervene, you get permission. So Japan clearly has permission, but that's not enough. But my concern is it's the same dilemma as I was just saying about Japan. The Fed, unless you really believe the Fed's going to be cutting more than it now is, you can't. Intervention alone isn't going to stop dollar strength.
And it's something, you were at the IMF meetings, the spring meetings in DC, something that the world and especially emerging market central banks are coping with. They're maybe nearing the end of their rate cutting cycle. Is that cycle going to be stopped short because they now have to think about the risks of currency depreciation? That's
a really good issue to raise, Danny. And the concerns of not just small open economies, but like Korea, which on fundamentals should be strong. And Korean, what we did have this tripartite announcement around the meetings of the Korean, the Japanese, and the American finance ministers all saying, you know, we're watching this. So these concerns are there. But I just, my forecast is just that it's just going to get worse because it's not like the American government is going to do anything this fall close to the election. So the pressure on the EM, the pressure on small open economies will continue.
We're going to squeeze one Bank of England question out of you because obviously that is where you sat and we're up against the clock here. Again, Hugh Pill says we're on Table Mountain. He's reluctant to come off that, a reasonable way to go.
Sorry, we're on...
Well, last August he said we were on Table Mountain in terms of rates. He was in South Africa.
Yeah.
Not the Matterhorn.
Got it.
But again, we're just curious in terms of if the Fed does not have the ability, as you say, to cut as much as the market thinks this year and next year, what about the UK? Just wrap it up with a bow for us.
The bow is the UK has surprised me on the upside in the sense that growth has been stronger, but inflation has come down more than I expected. And so I was worried the Bank of England was going to have to go up from Table Mountain, but I think they're going to be able to stay. The important thing is if the ECB moves, then there's space for them to move.
Okay. Everybody's got to make space along the way, this shuffleboard. Adam, great to see you, and welcome to Bloomberg Brief. That is Adam Posen, Peterson Institute, International Economics, our guest this morning on monetary policy. We'll leave you with a snapshot of the yen.
Yep, there we go. Yen weakening down 0.5% after around more of $57 billion has been spent in this week. Adam Posen says, that's small change, could be more. This is Bloomberg. This is Bloomberg Brief. I'm Danny Berger alongside Managed Cranny in New York. Let's get you set up for your trading day. Some economic data. We're going to get U.S. factory orders, trade balance, and initial jobless claims all at 8:30 a.m. Peloton, Wayfair, and Moderna all report their results before the opening bell. Then after the bell, we get Apple, the latest Mag 7 stock to report earnings. Manus.
Yep, let's see how those sales actually did do in China. Now, have you been cooking rather than ordering from DoorDash? I think Danny has. It offered a disappointing profit forecast for the current quarter. The company investing in expanding its list of non-restaurant partners and improving efficiency. The market does not like it. eBay down 3.25%. Gross merchandise sales also missing. And then you've got Qualcomm. I mean, the chips got really beat up yesterday on AMD, but they gave an upbeat forecast on sales and profit for the current period, suggesting that handsets are increasing after a 2-year slump. Danny.
Well, as I said, Manus, we are going to get Apple after the bell today. It's going to give investors a sense of how the iPhone maker is doing. We've had some bad reports on China. Let's go through it all with Bloomberg's Alex Webb. So, Alex, just for now, putting the China issue aside, or maybe that is the main issue, what do investors want to find out?
Yeah, I think China is very much top of the list. There has been reports or estimates that their sales in China might have fallen by as much as 30%. IDC estimates their global sales have fallen about 10%. Now, that doesn't directly correlate to, say, a 10% decline in revenue because they have a higher average sales price than many of their competitors. So even as the number of units they sell might have declined, they don't actually release those numbers themselves anymore. They are often able to push the price of the units they do sell higher. Now, there are other things investors would like to know, but they are unlikely to find out today, particularly when it comes to AI.
Well, what is it that you think that the market believes they can deliver on AI, or at least intimate about AI?
Well, look, they'll probably make some broad comments about having lots of stuff in the works on AI, being very confident about what they're able to do. The real announcements and vision on what their roadmap looks like will come at WWDC, the Worldwide Developers Conference, which is happening in a few weeks' time. That is when you'll have a real sense of what they're getting up to and actually on what level they're going to be competing with the likes of Google and Microsoft, who are really leading the charge in that space right now.
Alex, thank you very much. Alex Webb, all eyes down on the Apple numbers. There is only one story in town. It's in the FX narrative. Danny and I just sat down with Adam Posen from the Peterson Institute. We need to understand at the moment the Bank of Japan are throwing peanuts at the gallery of intervention on a relative basis. And I'm not being facetious because Adam quite rightly reminded us when it comes to size and scale of intervention, Japan has got deep pockets, up to $1 trillion, which was intervened in the 80s. And unilateralism, in his words, is not going to work on it. It's not going to work.
Because this time around, it's $57 billion, which I said to him, Adam, I mean, that's almost the entirety of what they spent in 2022. And he rightly said they've spent $1 trillion before. But the thing he lined up, Manus, is even if they spend $1 trillion, that's not enough. And it is an issue, he says, it's going to get worse, not just for the Bank of Japan, but for emerging market central banks throughout the world, banks like Korea. Again, it's only going to get worse because the Fed is not ready to cut. Jay Powell made that clear yesterday.
And a very clear message from Adam Posen, which was the message delivered by Jay Powell wasn't one that he would have delivered himself, which was closing off or trying to close off those reasons to a hike. He should have retained more optionality for himself and for the board.
Well, the fundamental difference, though, is that Powell thinks that rates are sufficiently restrictive. So he doesn't want to say something that sends exactly. So Powell doesn't want to say something that raises bond yields, whereas Posen says they're not restrictive enough.
No, that's it for Bloomberg Brief. Surveillance is up ahead.